5 stocks, 5 different sectors. One pattern that predicted every single move before it happened. Palantir from $6 to $270. Nvidia from $30 to over $1,000. Seagate from $95 to $800 in 12 months. Intel, every analyst on Wall Street called it dead, up 500% since August. Rigetti Computing, a quantum stock almost nobody had heard of, up over 1,000% before most investors even knew its name. Here is what the financial media will never tell you about those returns. The headline numbers are real, but the investors who actually captured them, the ones who held from the bottom to the top, were not lucky. They were reading a completely different signal than everyone else, a signal that was visible in the data months before it showed up in price. And right now, that exact same signal is appearing in 3 specific companies that most investors are not even looking at. If that sounds like something worth understanding, drop a comment below with the word pattern. I want to know how many people are actually paying attention to the right things right now. But before I show you the 3 current setups, I need to tell you the part of the story that makes the returns believable. Because without this context, the numbers sound like luck, and luck is not repeatable. Every single one of those 5 stocks, Palantir, Nvidia, Seagate, Intel, Rigetti, went through a period of maximum negativity before the move. Palantir fell from $23 to $6 while the tailwind was building. Intel was being described as a dying business while institutional money was quietly positioning. Seagate was being called a dinosaur company while every investor was talking about chips and models, with almost nobody asking where the data was actually going to be stored. The negative narrative was not a warning signal. It was the mechanism. It was the reason institutional capital could accumulate those positions at attractive prices, because the headlines were generating selling pressure from retail investors responding to noise instead of signal. The worse the media narrative, the better the entry. That is not a coincidence. That is a structural dynamic that repeats every single cycle. If this is already shifting how you think about your current watch list, share this video with one person who needs to hear it. The people most at risk are the ones who don't know this pattern exists. So here is the framework. 4 conditions. Every significant multi-100% move in an individual stock over a 1 to 3 year horizon has been preceded by the same sequence. First, a genuine structural tailwind, not a trend, not a narrative. A macro force operating at a scale that no single policy decision or market correction can reverse. Second, a real business, real revenue, real customers, a real competitive position inside that sector. Third, a beaten-down stock, either from a sector-wide correction, a company-specific disappointment, or simply the fact that it was not in the conversation everyone was having about that sector. Fourth, institutional accumulation beginning, the money that moves markets quietly building a position, visible in volume patterns and positioning data before it is visible in price. That 4th condition is the one most retail investors never see, because by the time it becomes visible in price, the easy money has already been made. The investors who captured the full move from Palantir at $6 to $270 were not reacting to price. They were reading positioning data while everyone else was reading headlines. Now here is the behavioral piece most people skip, and this is the part that separates the investors who actually held through to $270 from the ones who sold at $12 and called it a win. Every one of these stocks, during the window between institutional accumulation beginning and the broader market recognizing the thesis, generated powerful reasons to sell. Earnings misses, analyst downgrades, competitor announcements, media narratives that made the thesis sound broken. The noise was maximally negative at exactly the moments when the setup was most favorable. There is a specific mistake that destroys returns here, and it looks like discipline. Holding PayPal from $310 to $46, down 85%, because you believe in the business is not the same as holding Palantir from $23 to $6 to $270. The holding time is similar. The outcome is opposite. The difference is not patience. The difference is framework. PayPal's structural thesis changed, the competitive moat eroded, the growth decelerated. Palantir's thesis did not change during the decline, it strengthened. Every quarter, Palantir sat at $6. The AI-driven enterprise data opportunity was getting larger, not smaller. Holding is only the right decision when the thesis is intact, and the decline is a sentiment event rather than a fundamental deterioration. Distinguishing between those two conditions is the most important analytical skill in structural investing, and most investors never develop it because nobody teaches it. Like this video, if that distinction just reframed how you think about a position you are currently sitting in, because what I am about to show you next is where that framework applies right now, in real time. The first company is Fortinet, ticker FNET, and the structural tailwind here is more powerful than most investors currently recognize, because artificial intelligence has done something to the cybersecurity threat landscape that cannot be undone. AI-generated phishing attacks are now indistinguishable from legitimate communications. AI-driven malware adapts in real time to security countermeasures. Every Fortune 500 board is managing a threat environment that is qualitatively different from what existed 3 years ago. Cybersecurity budgets are not growing incrementally. They are doubling and then doubling again, because the cost of a single breach has become potentially existential for organizations operating at scale. Fortinet is not a generic cybersecurity company. It builds its own custom chips, ASICs, specifically engineered for firewall performance. The result is that Fortinet's security products are faster and cheaper to operate than competitors relying on general-purpose processors. That is not a marketing claim. It is a measurable performance differential validated in independent testing, and it translates directly into lower total cost of ownership for enterprise customers. The business generates subscription revenue, recurring, high retention, contractually predictable. The exact financial profile institutional capital targets in this rate environment. The stock was approximately 35% below its 2025 peak before the recent recovery. It is now approaching its all-time high from a position of improved fundamentals and an accelerating threat environment. Institutional positioning data shows accumulation. The cybersecurity budget cycle, which historically lags threat recognition by 1 to 2 years, is now entering the acceleration phase. All 4 conditions: structural tailwind, real business, beaten down, institutional money beginning to move. The second company is where most investors will stop paying attention, and that dismissal is precisely the signal. Compass Minerals, ticker CM, a salt and fertilizer company. I know. Stay with me, because this is exactly the not in the conversation condition I described, and historically that condition is where the largest asymmetric returns develop. The structural tailwind is food security. The world's population is growing. Agricultural productivity is not keeping pace. The premium crop segment, fruits, vegetables, nuts, specialty produce, is expanding as global consumer preferences shift toward higher quality, more nutritious food. These crops require specific high-efficacy fertilizers. Sulfate of potash, the specific product Compass Minerals produces, delivers results in premium crop applications that standard potassium chloride cannot replicate. This is not a commodity. It is a specialty input for a high-value agricultural segment with structurally growing demand. Now, here is the asset layer that makes this genuinely compelling. Compass sits on physical, irreplaceable reserves. A salt mine in Ontario operating for over a century with effectively perpetual reserves. A potash operation in Utah that is one of a small number of domestic U.S. sources for a critical agricultural input. You cannot 3D print these assets. Artificial intelligence cannot substitute for them. They are finite, physical, and strategically located in North America at a moment when reshoring of critical input supply chains is a government-level policy priority. The stock has declined from approximately $100 to around $27. That move was driven by debt restructuring concerns, weather-related operational disruptions, and the simple reality that nobody discusses salt stocks when Nvidia exists. Recent earnings came in better than expected. Institutional volume data shows early-stage accumulation beginning. The balance sheet work is progressing. The entry risk here is higher than Fortinet. The setup is earlier. And if the thesis develops as the agricultural supply chain dynamics suggest, the potential return is correspondingly larger. The third company is the one I find most compelling because it represents the deepest layer of the AI infrastructure thesis. The layer that most investors are not reaching even when they believe they understand the AI trade. Follow this logic chain carefully. Every major economy on the planet, the United States, Europe, Japan, South Korea, India, is committing hundreds of billions of dollars to domestic semiconductor manufacturing capacity. This is not a trend. It is a policy commitment backed by legislation, by subsidies, by government procurement, and by the specific lesson that COVID-era supply chain disruptions taught every government about concentration risk in critical inputs. Taiwan concentrates the manufacturing of the most advanced chips on Earth. Every major power has now identified that concentration as a strategic vulnerability. The investment to fix it is already in motion. Now go one level deeper than the chips. Every semiconductor fabrication plant requires precision instruments, gas flow controllers, vacuum systems, lasers, plasma sources, to perform the specific physical processes that chip manufacturing requires. Without these instruments, the plant cannot build chips. There is no workaround. There is no digital substitute for a physical manufacturing requirement. MKS Instruments makes those instruments. It supplies precision components and subsystems to the semiconductor equipment manufacturers, the ASMLs and applied materials of the world, and directly to the fabrication plants themselves. When a new chip fab comes online anywhere in the world, MKS generates revenue. When semiconductor equipment orders increase, which they are doing now as the multi-hundred billion-dollar fab investment cycle accelerates, MKS generates revenue. Think of it this way. Every country racing to build domestic chip capacity is building a factory. MKS makes the precision tools the factory cannot operate without. It does not matter which chip company wins the application layer competition above it. The tools are needed regardless. The stock has corrected significantly from its highs as the cyclical downturn in semiconductor equipment orders worked through the system. The recovery in orders is now beginning, visible in backlog data and confirmed in the earnings commentary of major semiconductor equipment manufacturers. The valuation reflects the cyclical trough in earnings, not the earnings trajectory of a company entering the upcycle of the largest coordinated fab investment in history. 3 companies, 3 different sectors. The same 4-condition pattern in each one. At the early stage, before the move has become obvious to the investors still watching what already ran. Now let me close with the behavioral piece, because identifying the setup is the easier half. The harder half is what happens next. Fortinet will have a quarter where a large contract is delayed. Compass Minerals will have a period where a balance sheet concern resurfaces. MKS will have a quarter where semiconductor equipment orders disappoint relative to expectations. In each of those moments, the financial media will provide a compelling narrative for why the thesis is broken. The question you must be able to answer in that moment is not whether the price is falling. The question is whether the structural thesis has changed. If the tailwind is intact, if the business is still real, if the competitive position has not deteriorated, then the price movement is noise. And noise, as Palantir demonstrated from $6 to $270, is not a reason to exit. It is the mechanism that creates the entry. The investors who captured those moves did not do so because they were comfortable watching a position fall. They did so because they had a framework that distinguished between the thesis being broken and the price being suppressed by sentiment. That distinction is learnable. The framework is available. The 3 setups I described today are visible in the data right now, in the early stages, before the move has become obvious to everyone else. The only question is whether you are watching the right signals. If this gave you a genuinely different way to think about how institutional capital moves, and how to read it before price confirms it, Consider subscribing for daily updates on exactly these types of setups. No noise, no hype. Just the framework, applied to what is developing in real time. The next video covers how to read institutional volume data yourself, without a Bloomberg terminal, without a paid service, using publicly available data that most retail investors walk past every single day. It is already up. Watch it next.